So thank you everybody for coming. And the way we are going to do this is Mike and I will introduce each other. We are going to go through everything. And there will definitely be time at the end to answer questions. And frankly, we'll just stay on as long as people still have questions. And hopefully we will be able to answer the questions during our presentation, but I'm sure there'll be questions that we will not answer. And Alex is asking, will you be able to share the recording? Yes, I hope so, if everything goes well. I've done some of these and sometimes, we don't get the recording, but hopefully we will. And assuming that we do, we will share a recording with you probably put it up on our website. So,
And I imagine that goes for the slides as well.
yes, the slides are not a problem. We will definitely email you the slides. So you do not need to take down notes if it happens to be something that's on the slide. So, okay, people are still coming in. But in respect for everybody's time, I think we should get going. So, welcome. This is going to be a presentation on college financial and merit aid. And I just want to let you know that we run a service called College Money Match, and our company is Cereus Financial Advisors. With College Money Match, we help you navigate college finances. And quite frankly, we want you to pay less for college, not to get into too much debt. We want you to maximize either your needs-based or your merit aid, or sometimes both. We want you to understand how much each college might cost before you apply and create a plan to make sure that you can handle the entire undergraduate expense. And many folks have more than one child, so that you might be here often. You want to get information before the first child, but remember, you might have other children that you have to pay for as well. And you do not want to be paying off your child's college expense in retirement, or have your child be paying it back in their retirement. So that's the general idea. A little bit about me. I founded Cereus Financial Advisors in 2015. It is a second career for me. I started off as an electrical engineer and software engineer, so I have a very analytical thought process, I guess. I also have an MBA in finance and went back to school and got the Certified Financial Planner designation, which required some schooling, an exam, and some years of experience before I could call myself a CFP. And a few years ago, actually during the pandemic, I developed the College Money Match process to help parents make better choices. And I do have experience with my own kids, which was before College Money Match. And I have learned some things since then, and certainly would have done a better job had I known everything that I know now. So my daughter got some money from Gettysburg. My son, with my son, who is the oldest, I definitely made some mistakes. And now I'm going to introduce Mike Dunn. And Mike will introduce himself and take you through the first part of the presentation.
Good evening, everyone. Thank you for joining us. My name is Mike Dunn. I'm also a certified financial planner, and like David, this is also a second career for me. Although it's my entire working life has been finance related. I started out as a CPA, then worked for a number of years at a couple of large banks in New York City. and then for another several years for a large hedge fund client that I got to know while I was in banking, and took the CFP exam in 2016 and joined Cereus here in 2018. So along with training myself as a CFP, I've also recently become an adjunct professor of financial planning at Fairleigh Dickinson University, and training more folks to sit for the CFP exam and become CFPs. So we're hoping to spread the word that CFP is a great designation to have. We take a fiduciary approach, which means we put your interests ahead of our own. And that's a good question to ask any financial planner that you decide to interview. I also have experience with putting my kids through college, and I will second David's notion that I would have done things differently if I had known then what I know now and what we'll talk about this evening. So no matter where you are in your college planning journey, I'm sure you know that it is a major undertaking to think about how much you'll be paying for your child's or your children's college education. On this slide, we show a couple of comparative expenditures. One of the I'd say more reasonably priced towns in our area here, Waldwick, New Jersey, and Bergen County, a recent price of a 3-bedroom, 2-bath house, $550,000. And right next to that, the price of NYU, like buying another house, to pay for 4 years at NYU, being perennially one of the most expensive private schools in the country. Comparably, or by comparison, a well-regarded public state university, the College of New Jersey, more reasonably priced, but still a major undertaking at nearly $175,000 for 4 years. If you go to the next slide, David. So why is college so expensive? Well, it's not because of the cost of education. According to a study a few years ago, it only cost about $14,000 to educate a student at a public university. It is not because of the highly paid administrators who work at the school and who run the school. As you probably know, many schools have added some great features to attract students, but it's not because of their new cafeteria, the great food, or the lazy river that they've installed on campus. College is so expensive because some people are willing to pay that much. Although perhaps some good news is that a large majority of students at private colleges got some amount of financial aid in the college year 2019 to 2020. I will add also that cuts in state budgets have meant less funding in the state budget for public universities, which has shifted more of the burden for paying for schools, the public universities and private as well, onto parents and students. If you go to the next slide, David. So it might be helpful to think about shopping for college as if you're shopping for, I don't know, we showed an example of how much a car cost recently, or perhaps airline tickets. You start with a very high list price, but there are discounts available. If you can demonstrate financial need, there's financial aid for needy families that'll give you a discount. Or if you're not eligible for needs-based aid and your student is a good student, there are discounts available for merit scholarships and things like that. So subtracting those kinds of things from the very high sticker price will give you a net price. And every student situation is different. Every family situation is different. So it's very unlikely that many students sitting next to each other in the classroom will wind up paying the same amount for their education at that particular university. Next slide, please, David. So the way this presentation is going to break down in terms of my segment versus David's is I'll spend the next couple of slides and next couple of minutes speaking about needs-based financial aid, which is mainly a formula-driven determination based on financial information that families and students submit. And then David will pick it up with talking about merit aid or scholarship aid, which, believe it or not, is based not only on the desirability of students, but perhaps on the desirability of the parents as well, as David will explain when we get to that. So we start by strongly recommending that everyone fill out the free application for federal student aid, otherwise known as the FAFSA, FAFSA. And the formula that the FAFSA comes up with is uh, they make a determination as to how much each family can afford to pay. This concept used to be known as the expected family contribution, or EFC. There have been some changes to the FAFSA process and the FAFSA form, which were implemented this year, and they no longer call it the expected family contribution. They now call it the student aid index, but it means the same thing. The thing about the EFC or the SAI is that the college's idea of what you can afford to pay is probably very different than what you think you can afford to pay. Colleges generally don't meet 100% of financial need. And as an example, Gettysburg College had an estimated cost of attendance of nearly $86,000. And 90% of financial need is met, not 100% of financial need. And of the amount that is met, 91% of that is made in grants, which are the best form of financial aid because you don't have to pay it back. But aid can be in the form of grants, loans, or work study, jobs on campus that'll help students earn money to pay for college. The sources of financial aid can be the federal government, state government, or the school itself, or a combination of all of them. Generally speaking, when you're talking about financial aid based on need, you have to reapply for it every year. So apply for the first time right before admission, and then each year after that, you'll be filling out the FAFSA again, as the schools will be checking to see that your financial eligibility remains the same. Next slide, David. So there are three. I'm tempted to say actually only two now, and I'll explain in a minute. Three financial aid calculation methods that are employed by schools, and this is strictly for needs-based financial aid. Once again, so there's the federal method, which is used by most public colleges and universities, where all of the applying students and families fill out the FAFSA. Their expected family contribution or student aid index gets determined. And what is included in the formula, or I should say what is not included in the formula, generally your income, parents' income and assets and students' income and assets are included, except the value of parents' IRA accounts or 401k accounts, or the value of the equity in their home is not considered. They didn't used to also ask about the value of a small business if parents own a small business. That has changed for this current school year. Now they look at the value of a small business in terms of determining how much you can afford to pay. So generally speaking, of course, you want your student aid index, or the amount you can afford to pay, to be lower to qualify for more financial aid. The more resources that you show that you have in terms of mostly income, but in assets as well, the less eligibility you'll have in the financial aid determination, at least as far as needs-based financial aid goes. So that's the federal method. There is also a method known as the institutional method, which is used by many private colleges. Not only do we fill out the FAFSA, but they ask for another form to be completed called the CSS profile. And then each college takes that information and applies their own formula. So it's not standard across the groups of colleges that use this method. They may decide to look at the value of parents' retirement accounts, IRAs, 401ks, annuities. They may decide to look at the value of equity in the family home, as well as the value of any small business that the parents may own. So up until recently, there was a third method known as the consensus method, which was used by many elite private colleges. But because of a price-fixing lawsuit, this form of collusion was considered to be collusion and is not allowed to be used anymore. But generally speaking, it's very similar. It would have been very similar to the institutional method. You fill out the CSS profile form in addition to the FAFSA, and they can look at almost anything as well. Retirement accounts of the parents, annuities, value of a small business. They limited the amount of home equity that they considered in the parent's home. And the value of any 529 plan accounts were considered at a 5% of 5% value. Next slide, please, David. So it's a bit of a black box in terms of the formula that is applied to determine the student aid index or the expected family contribution. It begins with parent income. Depending on the amount of parent income, they may apply a percentage ranging from 22 to 47% in determining how much a family can afford to pay toward their students' college education. Next, they will look at students' income. So if a student earns over, and this is in this current year, a student earns over $11,130, 50% of that income is expected to be used or contributed toward the cost of school. It's a good idea for the students perhaps to have some income, but you don't want to shift too much income because it is then penalized by being assessed at a very high rate in the financial aid determination. Also, in terms of assets, 20% of students' assets are considered as eligible for the student aid index, which might reduce a family's and a student's eligibility for needs-based financial aid as well. That does not include the value of any 529 accounts. 529 accounts are considered to be assets of the parent. And as you see in step 3 here, parental assets are assessed only at a rate of 5.64% in determining the student aid index, what the family can afford to pay for school. And that includes 529 plans. Next slide. So there's been some changes with respect to how the FAFSA and how universities will look at divorce situations in terms of eligibility for needs-based financial aid. In the current academic year, the year that's ending very soon, in May or June, they looked at the income and assets of the custodial parent only. But going forward, they're changing that. So the college year that begins this coming fall and thereafter, they'll look at the income and assets of the parent who pays the most towards the child's maintenance or upkeep. That's for the federal method. The institutional method and the consensus method schools, you can scratch the consensus here, already look at both parents' income and assets in determining needs-based financial aid. Next slide, David. So now that they're looking at the parent that pays the most for upkeep, who really knows which parent is paying the most for upkeep? I don't know that they have a way to really, I suppose, prove that. So it may be a strategic move to complete your financial aid forms, the FAFSA, by picking the lower earning parent if possible. Any payments received for child support are not counted as income in the student aid index. So that may be a benefit. Also, with respect to now the fairly new requirement to report the value of small businesses owned by the parents. You as a parent or you as the business owner will be asked to come up with a valuation. You can be conservative, but use a methodology, a repeatable, explainable methodology. It will be difficult to be challenged, but I think it's important that you're able to show that you used a methodology that makes sense and isn't just, a number that you decide to pull out of the air more or less, which can change from year to year. Next slide. So that concludes the needs-based financial aid portion of the program. I'll turn things over to David to discuss the merit aid and continue on from there.
Thanks, Mike. Um, Actually, just going back to the small business valuation, I'll just give two quick examples. Um, if, for instance, the small business is some kind of consulting business, where the the earnings, which may be significant from the consulting business, are all due to the owner's consulting. And if the owner, the owner is not part of the business anymore, the business is probably not worth anything. It may be very fair to actually enter a value of zero for the worth of that small business. But if you turn around and maybe the business is, let's say, a trucking company that may own 10 trucks, and those trucks are all worth quite a bit. And maybe there isn't much debt. So because you've run your business well and you've got this trucking company where you have significant assets, your business is really going to be worth what the trucks are worth minus any debt. So it just gives you some examples on valuing small business, and it can be challenging. So let's talk about Merit Aid. Uh, you can think of Merit Aid really as a discount. So the colleges provide a discount to students that the college thinks are desirable. And they're desirable because maybe they're at the high end of academic performance, and they pull the school up in terms of their academics. Those students may be active contributors, leadership positions in clubs or activities, sports or music achievement. So even on a Division III school, you're not going to get the same kind of full ride that you would get if you were a sports star at Division I, but being a sports leader still might give you some merit money. Um, Music achievement as well. So if the school's band needs a tuba player, and your child is a tuba player, a very good tuba player, they might be more likely to get both admitted and also get money. Um, and then some schools have geographic goals. They want to be diversified geographically. So, if you're a New Jersey or New York student and you're applying for a school in Connecticut or Pennsylvania, big deal. But if you apply to college in North Carolina or maybe Montana, that might be a big deal. They might want some Northeast students in their schools. And then major is another factor, especially sometimes applying to a non core major at a college. So, the English major at the engineering school may get you a little bit more money because they want to attract students to that major at that college. And then just like getting in, you want to demonstrate interest to the college. Visit the college, go to the webinars, go to the admitted days, the weekends, show interest in the college. You're more likely to get some money. So another important factor is that you can bargain once you get accepted by writing an appeals letter. So I have to say that this varies from year to year. And the current cycle that I'm in right now with my clients, they have not been getting much money in appeals. But the year before, students did pretty well in getting appeals money. So it does vary from year to year. It has to do with which college and also what the freshman class is looking like at that particular college. And when you do appeal, it typically has to be based either on something that's changed in your record that makes you more desirable, or you can bargain actually based on another offer at a comparable school. So, I'll pick Gettysburg again. My daughter happened to go there. So, their arch rival is Dickinson, another Pennsylvania school, or frankly, Bucknell. So, if you wanted to bargain at Gettysburg and you got a nice offer at Dickinson, you can use that nice offer at Dickinson and say, well, I really want to go to Gettysburg. It's my first choice, but I got this offer from Dickinson. Include the offer, write the appeals letter. Chances are they will match it or do slightly better. Um, merit appeals are definitely more likely at private colleges. The public colleges don't have that much money. Public colleges do give merit awards, but they're often not appealable. The nice thing about merit aid is that it's usually renewed automatically. So whatever you're getting freshman year, maybe they're going to give you a $20,000 merit scholarship freshman year. That $20,000 will renew, and you'll get it sophomore year, junior year, and senior year as well. You may have to meet academic goals. Sometimes it's a 2.8 or better average. Sometimes it's a 3.0 or better average. A lot of colleges are kind of doing away with those goals, but some of them still have it. You really need to remember that college is a commitment for 4 years. You really need to make that budget for 4 years, not just the first year. People have a tendency to just look at the first year and maybe they've saved some money in a 529 plan. You spend it all the first year, and then you figure the next years you'll worry about it then. I would say it's much better to create that budget for 4 years, and it could be more than 4 years. Um, Rutgers, New Brunswick, in the recent past had only a 66.8% 4-year graduation rate. Now there are lots of reasons for that. They aren't necessarily that the kids are having trouble. Maybe they're taking a co-op year, um, or in the case of Rutgers, they might have non-traditional students who are going over a longer period of time because they're going part-time. But at any rate, it's important to realize that it often may not be just 4 years. It may even be longer. And you do not want $100,000 of debt for your degree. Think about it though. Private colleges, which are costing between $80,000 and $90,000, $100,000 of debt really implies about $25,000 a year. And just do the math with how much you may get very nice merit award and still need to spend $25,000 a year and end up with $100K plus of debt. It's more and more difficult because the colleges are getting more and more expensive, and the aid is not necessarily getting that much better. The aid is not increasing at the speed that the colleges are raising their prices. I highly recommend that you have your student as part of the financial process from day one. Make sure, in many cases, the student is going to take on some of this debt, some or all of the debt. So you want the student to understand what going into debt means, and the financial part of the decision is an important part of the decision, maybe more important than some of the other aspects. And nowadays, unless you're very wealthy, your student cannot afford to go to any college they want. And I need to reiterate that you need to fill out the FAFSA. So first of all, you need to fill out the FAFSA because you want to be considered for financial aid. But maybe you know that you're not going to get financial aid because you make too much money. Well, if you want to use federal student loans, you need to fill out the FAFSA. because if you don't fill it out, you won't have access to those federal student loans. And then some colleges really want to give you they want to see the FAFSA because that might give you a better merit aid offer. Colleges are often not very clear about how they make their merit aid decisions. And if they think they might get some money from you in donations because you actually are very wealthy, then filling out the FAFSA kind of tells them that, and maybe you'll get a better merit aid offer. So all good reasons for filling out the FAFSA, and it might actually help you get into the college. So I'm going to talk a little bit about the loans that are available. And we have an ebook, which I'll tell you about right at the end, that goes into a lot of details about funding possibilities, including loans. So first of all, we have federal student loans. These loans that I'm really talking about are the federal undergraduate student loans. The current interest rate for the kids who are going to college the fall of 2024 is at 5.5%. They will announce the new rates by the end of June, I believe. I do not expect them to go down. We'll be lucky if they stay the same. There's a 1% origination fee. There are actually two types of loans, a subsidized loan and an unsubsidized loan. They are not very different. With an unsubsidized loan, the interest accrues from day one, but it's deferred, so it gets capitalized into the loan. Although that's optional, you could actually pay the interest if you can afford to pay the interest. With a subsidized loan, those loans are interest-free while they're in school and for 6 months afterwards. So the subsidized loans are slightly better, but as a freshman, the maximum subsidized loan, I believe, is $3,300. And the maximum federal loan altogether is $5,500 as a freshman, $6,500 as a sophomore, and $7,500 after that. So, and the maximum that you can take out is $31,000. This is for undergraduate. So you hear about everybody, you hear about massive student loan debt. A lot of that debt, if it's in federal loans, it is really probably graduate loans, because only with graduate loans can you really get a very high debt amount, or you're not paying and the interest is accruing. So these loans are eligible for all the best income-driven repayment plans. They're dischargeable on death and disability, and there's several loan forgiveness programs, the best being public service loan forgiveness, and they're eligible for all of that. And President Biden has tried to do a bunch of student loan forgiveness. Really, he was talking about these loans and the Graduate Plus loans. So these are the loans that you want to go to first, and they are in the name of the student. Then you have federal Parent Plus loans. Now these, I would call these loans very expensive. They are at 8% right now, and they have a whopping 4% origination fee. They depend on your credit score. There's no income verification. There's also no maximum except for the cost of education. And by the way, these loans all get paid to the school, so you don't get to see the cash. The Parent Plus loans are eligible for an income-driven repayment plan, but it's one that's not particularly generous. It's called ICR, income. I forgot what the initials stand for, but anyway, um, I probably, oh, yes,
I think
thank
that's income contingent repayment, isn't it?
right, right. And Joe Shore, who's actually a colleague of mine in the Financial Planning Association, reminded me it's, yeah, income contingent repayment. Anyway, it's eligible for that if it's consolidated, which is basically a way of putting loans together to create a new loan. This loan is discharged on disability and death. One nice thing is that it is eligible for public service loan forgiveness. This is a program where if you're in it and you pay for 10 years, anything left after the end of 10 years will be forgiven. And that's if you work in public service. What that's defined as is working for a nonprofit or government. Uh, Nonprofit could be, for instance, a hospital, if you're, let's say, in the medical profession, um, or a school, if you're a teacher. That's all counts as public service and you'll be eligible. This is for the parent. So normally I would say I don't particularly like these loans because they're so expensive. But if a parent is working in public service and might be eligible for the loan forgiveness, then it's definitely something to look at. One thing to point out is that federal loans are often not discharged in bankruptcy. They really hang around. Um, Only if you can prove that there's no hope whatsoever of paying it back, which means not only are you not working and earning income, but there's no hope that you will because maybe you're permanently disabled. So there's some other loan programs. Several states have some very nice state loan programs. So New Jersey has one called NJ Class. The student or the parent can be the borrower. And as you can see, the interest rates are lower than those Parent Plus loans. And there's a lower origination fee. So the 5.69% is a 10-year loan. And as you stretch out, think to 20 years, can't remember, but the longest loans have that 7.49% rate. It's for students who live in New Jersey and go to an out-of-state school, or out-of-state students who attend school in New Jersey. And so I happen to like these loans, especially compared to the Parent Plus loans or to private student loans. New York, unfortunately, does not have a state loan program, but Connecticut and Pennsylvania does. Connecticut's is also pretty nice. Pennsylvania is really just sort of a repackaged private loan program, I believe. But Connecticut also has a nice program that I was just looking into for a client. And with Connecticut, it's the same thing. It could be an out-of-state student who goes to a Connecticut school or Connecticut resident who goes out of state. Then your other choice is private student loans. The rates are going to vary. Usually you would have the student as a borrower with a cosigner. Once the student graduates and pays for a while, a lot of loans, you may be able to remove the cosigner, but you have to check the loan terms. Certainly there'll be a credit check and income verification, and other terms vary. I wrote here that they're often not dischargeable on death or disability. That is starting to change. Even the private loans do often allow discharge on death or disability, but not all of them. You really have to look at the terms. And then, of course, it doesn't need to be a student loan. Maybe you do have home equity available. Home equity is going to be cheaper than the student loans. There may be other forms of borrowing that are available to you. So, don't think just because the student, you have a student going to college that you have to borrow using a student loan. You don't. And I do want to remind people that you actually can borrow $50,000 from your 401k plan. It's actually 50% of the balance, up to a maximum of $50,000. You do have to pay it back over time. And if you leave your employer, I think it's due. They changed that rules recently. It used to be due immediately, but I think now you may have up to a year to pay it back. But it is due um, relatively quickly. So you want to have stable employment to use this, but it is an option for people. The nice thing is you're borrowing it from yourself. And although there's an interest rate on it, the interest is actually paid into your 401k plan. So I need to point out that college choice is an important part of this formula. The more prestigious the college, the fewer discounts they're going to provide. So if you go to an Ivy League school, I'll pick on Princeton, wonderful school. There are no merit aid discounts at Princeton. But if you need, if you have financial need, Princeton will cover 100% of that need. So it's a great school if you're excellent academically and not at all wealthy. But if you are wealthy, you're going to have to be able to afford to pay for it. Financial aid and merit aid are predictable. They're predictable because the colleges are supposed to be publishing their methodologies. And that's actually what we do at College Money Match. We have software that allows us to predict the financial aid and the merit aid based on your family financial situation and also the student's academic situation. It is a prediction, but I didn't change this slide because this came over from last year. The FAFSA situation was horrible this year. It's still not resolved for many students. The deadline is normally in October 1st. This year it was moved to December and ended up being the end of December before the FAFSA even opened for use. And then it didn't work and didn't work and didn't work. And we still have clients where the FAFSA is unresolved. It didn't work properly. So it's a mess. Hopefully I'm talking to more current juniors or earlier, and by the time that you're going to apply, the FAFSA will be again October 1st, and they will have fixed all the issues. So cross your fingers. You need to think about schools that you may be able to use for bargaining. Since you can use College Money Match to forecast aid, you might find some more generous schools and apply to them to maybe bargain for the school you really want to go to that's maybe normally less generous. How you apply is also important. Early action, rolling registration, those are all great tools. They weren't as good this year. They weren't as good because the schools did not provide the financial packages. So they told you were in, but because of the delayed FAFSA, they weren't giving you a good financial package. But in normal years, they give you the financial package right away. So that means you can write appeals letters before the very end. And it allows you to get a good handle on what your choices are. But early decision is at least theoretically binding. So that is not great for finances because the schools do not need to give you a great package because you've already told them that you're going to go there no matter what if they let you in. So I would definitely avoid early decision, early action, rolling admissions. Those are great. I think parents should create a budget prior to application. Really make that part of the plan before the student applies. There's not much point if you're not going to get much aid and can't really afford, a very prestigious school. you really want to make sure that you're applying to schools that you can afford. I've had some students who decided they didn't want to go to an in-state public school, even though they would get in and probably get a very good um, aid package there, and only applied to out-of-state schools and private schools, got in, but ended up not having good financial choices. So I really always recommend that you apply at least to the in-state schools. Make your child apply to, if you're New Jersey, Rutgers, or College of New Jersey, or Rowan, or Ramapo, or whatever. And if you're in New York, apply to some of the SUNY schools. They're great schools. Um, Connecticut has great schools, public schools. Pennsylvania has great public schools. So apply in state, and that can be then a choice afterwards. Whoops, my slide is, there we go. Okay, so I want to do a little case study here. We have a student, Malcolm Morris. The parents are John and Esther. John makes $140,000 a year, and Esther makes $30,000. They work hard. They are actually pretty good savers. Home equity of 300,000, 155,000 of savings and investment, and 355,000 retirement accounts. Malcolm is a senior in 2025, so junior right now, and he has a sister, Ann, who's 2 years behind him. Malcolm's a smart student, 3.95 GPA, and he got a 34 in his ACT, and he wants to major in English. So this is the example here, and he's applied to, one choice is Bergen Community College. I'll explain that in a minute. But that's actually a 2-year college for an English major. So the plan there would be go to Bergen Community for 2 years and then transfer to a public college in New Jersey that will accept the credits. And he also applied to Brown, Gettysburg, Marist, College of New Jersey, 4-year in-state college, University of Alabama, Delaware. Lots of New Jersey students love University of Delaware, University of Rochester. And the COA column is the published cost of attendance. That includes room and board. Bergen Community has built dorms. So now the COA listed here includes room and board, but actually, if you commute, it's only about $8,000. So that is a little bit misleading here. The SAI is the student aid index that gets calculated using the methodology. And for the FAFSA schools where there's an F, you'll see that it's 32,400. It's kind of what they're expecting you to pay. Student aid index is now a sort of a complex concept. But anyway, the lower it is, the more aid you might get. At the private schools, the ones with an I, which is institutional method, you'll see that the amounts vary a little bit. Gettysburg and Rochester is 34,100, but Brown is 19,500, because it used to use the consensus method. Now it's not called that anymore, but it doesn't count as much, for instance, 401k money. So the COA minus the SAI is the need. So that's how much aid is needed at those schools. And then these two columns, institutional need-based grants and merit scholarships, this is the money that Malcolm is expected to get. So Brown is going to give a lot of needs-based aid, $74,690 if he gets in. Gettysburg is also pretty generous, going to give quite a lot of aid. Um, Gettysburg also would provide a merit scholarship. Usually you do not get both the grants and the merit scholarship. Um, Sometimes you do, but the assumption here is that you don't. So you usually will get the one that's higher. Um, so some of them are calculating need. You'll notice that the public schools do not calculate need. They really don't have much money to go around. So they're not going to give you needs-based aid, especially out of state. But they are giving some merit scholarships, so that's nice. Even Delaware, which is not a particularly generous school. So the first year net cost is kind of the bottom line. Again, Bergen Community, this is for staying in the dorms, which you typically wouldn't do. So you'd be commuting and it would only be about $8,000. So actually Brown is the cheapest. It's also a very hard school to get into. The University of Alabama, which is an out-of-state public university, they would really like Malcolm because he's demographically desirable for them, and they're going to provide quite a bit of merit scholarship. So the price is $28,322 net. And some of the other schools are actually surprisingly expensive. Marist used to be a bargain, and they've kind of gone up, unfortunately. So the first year net cost for Marist is about $47K. So this is an example, and this is actually real output from our College Money Match software. And this is something else you get, which is outcomes. So the assumption here is that for all 4 years, any gap is going to be filled with loans. There is help in creating a budget, so it may not all be loans, but the assumption here right now is loans. Here's an expected first year salary for an English major from all these schools. How do we know what this is? The schools are supposed to publish it. So this is information from the college itself. You graduate as an English major from Brown, you're going to make the most, $58,450. Is it that much more than some of the others? Well, $10,000 a year more than from the University of Delaware. So that's interesting. But anyway, if you're on a 10-year payment plan for the loans, you can see what the payment is going to be compared to the take home, and you're given an affordability profile. So this can help you make decisions. We're getting kind of late, so I want to rush through this a little bit. There were a lot of FAFSA changes. It was a disaster this year. Hopefully it'll all be fixed. One thing I'll point out is the FAFSA form is shorter. That's because data is automatically entered from your tax return. You are required to allow this. So the only time that you may have a real issue is if you're on extension to the very last minute. So hopefully you're not, and you've done your taxes soon enough that you're able to do this automatic entry. It does make, at least theoretically, it makes filling out the FAFSA easier. Hopefully that will be the case this year. We talked about divorced parents. For the federal student aid method, the discount for multiple children in college has been eliminated. This is the first year. We are not through this yet. It does have a major impact if your children are going to schools that only use the FAFSA and you have multiple children in college at the same time. The CSS schools do have a formula for multiple children in college, and you do get actually a discount. So I think some of this, I mean, basically, you're coming to the FAFSA with the new rules. The parent income allowance has increased. One important point is that grandparent or other family monetary support or gifts is now no longer counted. It used to be counted. So if you have rich grandparents and they want to provide money for college, it's not counted against aid. If there is a 529 plan in owned by the grandparents, it is not counted against aid. So that is possibly something that could be useful. So this came from 2021. We have a student who got a full ride to lots of colleges, and then got a $40,000 scholarship during her graduation ceremony, and she turned it down and told the high school to give it to somebody else. So that sounds great, made the paper, but it turns out that if you get financial aid, needs-based aid, and then you get a scholarship, an outside scholarship, you actually have to report it, and your needs-based aid is reduced by the amount of the scholarship. So those are the rules. They're actually federal rules, and I just want to point that out. So if you're getting needs-based aid, some of the schools, the schools vary with their policies. They may reduce the subsidized loans and the work study first before they reduce the grant, but you'd want to find out. And you may not want to go and get a lot of outside scholarships when you're eligible for needs-based aid. So how will you pay for college? I think this is the important question that College Money Match helps to answer. And we take an approach where we're trying to help you make good decisions. There's no magic here. It's knowledge. And the more knowledge you have, the better off you are. So I just want to close, and we will answer questions, but I want to point out that we have an ebook that you can sign up for on our website. And the URL is listed here, but if you go to our website and just scroll down a little bit, collegemoneymatch.com, and scroll down a little bit, you can find the ebook. It goes into excruciating detail about the student loans and some of the tax breaks that are also available for educational expenses. Okay, and now I would be happy to answer questions. So you have your choice. You can write the question in the chat. If you want to unmute yourself and ask the question live, that's fine as well. And I'll tell you what, I'm going to stop sharing the slides, which may make it a little bit easier.
So,
Hi.
go ahead.
Yeah, sorry. My name is Alexa. I just have two questions. One is in regards to the divorced families. If one parent is remarried, and when we fill out the forms, does that spouse's income come into play for financial aid and grants and so on and so forth?
Yes.
Okay.
Because the tax return, your family tax return is what is going to go into the FAFSA. So the answer is yes.
Okay. All right. Thank you very much. And the only other thing is, for the FAFSA, does it open on October 1st or does it end on October 1st to finish filling out, assuming next year goes normal?
It opens on October 1st and closes on June 30th.
Okay, thank you.
So if you might get needs-based aid, you want to fill out the FAFSA early, October 1st, as soon as you can. If all you care about is access to the student loans, you can delay and delay and delay, but make sure you do it before June 30th.
Thank you very much. I appreciate it.
You're welcome. Okay, anybody else? We do have somebody, Sylvia wrote a question here. When do you apply for financial aid? Do you apply every year? Or do you do it once to cover all 4 years? And the answer is that you apply every year because your financial situation might change from year to year. And so you're filling out the FAFSA in the fall of the year before attendance. So if your child is a senior in 2024, you're going to fill out the FAFSA in the fall of 2024, and that covers the cost of attendance for the fall of 2025 as a freshman, and then you end up applying every year.
Hi, this is Alex Neminov. Quick question. Whenever I'm applying for the financial aid, doesn't matter loan or whatever, the household income, does it really counts how many people are in the household?
Yes. And there's a somewhat complicated formula for that was recently made even more complicated. So the amount of Pell Grants that you might get, and the Pell Grant is the primary federal grant, relies on where you are on the, I'll call it the poverty scale. And that has to do with how many people are in your household. So, so the answer is yes.
Thank you.
So I'll point out that if you don't make enough money to file taxes, then you automatically get the maximum Pell Grant. And of course, most people make enough money to file taxes. So then you may or may not get the maximum Pell Grant. The changes that they made this past year, which, as I said, are rather complicated, so I would always use software to calculate it. It did push more people to get the maximum Pell Grant than previously. Okay, anybody else have another question?
There was a question in the chat earlier. Who has to be in public service, the student or parent? Which I answered in the chat, but happy to discuss that. What I wrote was that the borrower has to be working in public service to be eligible for public service loan forgiveness. So just to use an example, if your child graduates and becomes a teacher and works for a public school, that is working in public service. But if that child has a student loan in their name, that means they would be eligible for public service loan forgiveness, assuming that they make all required payments for at least the first 10 years. However, if instead you used a Parent Plus loan to pay for their education and you don't work in public service, then that loan will not be eligible for a public service loan forgiveness. So just to make that distinction.
Yep. Okay, any other questions?
I have a question. I don't know. Can you hear me?
Yes.
Oh, I don't know if I'm saying this right, but as far as putting it into the question correctly, but For a family of 2 working parents, is there like an average annual income that would cap you out of being, eligible for financial need? Is it if you make like, you know, $500,000 a year, you don't apply, but if you make 150, you would be eligible? Is there a number?
Well, in the example, the two parents made about 150,000 combined, and they had an SAI of I forgot what it was, 34,000 or something like that. Which meant that at the more expensive schools, yes, they were eligible for needs-based aid. I don't know what the magic number would be.
Right.
Maybe it's somewhere close to 200,000 where, even at the very most expensive schools, you basically wouldn't be eligible for aid
Okay.
or
So it depends
for
on the cost of
needs-based aid, right? You're
needs.
always
Yeah.
you're
Mhm.
always eligible for merit aid.
Right. Needs. Okay. All right. Thank you.
Just to add to that, one of the things that I think in retrospect that I didn't know, my wife and I both work and make, reasonably good incomes, and we thought we would not be eligible for financial aid, so we didn't bother filling out the FAFSA at the time. And I think that was a mistake in retrospect because at the very least, our kids could have been eligible to use the federal direct student loan program. And that's not with the intention to saddle them with lots of debt, but there are small, reasonable amounts that I suppose you can have your kids have a little, quote unquote, skin in the game. Um, and they are the most reasonable in terms of interest rates and repayment terms, and it might have been a nice option to consider. I don't know if we would have done that, but by not filling out the FAFSA, you don't give yourself that option. So it never hurts to fill that out, even if you think you're not going to be eligible for needs-based aid.
Yeah.
So we have a couple of questions in the chat. Does 401k count as an asset for FAFSA? Sorry, the questioner missed that earlier in the presentation.
So you want to answer that, Mike?
The 401k does not count as an asset for FAFSA purposes. It might for the institutional method and the CSS profile. So depending on the schools that you apply to and the financial aid form that is required by that school, most public universities would not ask you for information about your 401k accounts.
So next, Kim is asking, how reliable are the calculators on college websites? So the government requires every college to have a calculator, and unfortunately, some of them are highly unreliable, and some of them are very reliable. And by reliable, I really mean, give you an accurate picture by asking you the right questions and providing a good answer. So yeah, they vary, and they still vary. And then Judy's asking, still no geographical leveling in FAFSA. So the answer is that it's based on the poverty table, and the poverty table is level for the 48 states other than Hawaii and Alaska. So they get a different table. So no, New Jersey versus Mississippi are treated, they are treated exactly the same way.
Margot's asking to confirm, I will apply for FAFSA this fall 2024 for graduation year 2025. That is correct.
Oh, Elaine is asking, how does one pay the 401k loan back? I forget the term of the loan, maybe 5 years. I can't remember what the term of the loan is, but you are paying it back through your payroll. There's a payroll deduction for the loan.
And then Sylvia asks, is the interest rate lower if the student takes out a loan rather than the parent?
Yeah, and the answer is no. I do not believe that there is any difference in the interest rate, at least for those loan programs that, you know, provide you the choice. So the federal student loan has a lower interest rate than the parent plus student loan, than the federal parent plus student loan. So that is true, but those are different loan programs. If we take the NJ class or the Connecticut state loan programs, it doesn't matter. The interest rate's the same. And I believe that's true for the private loans as well. Okay, any other questions?
I actually have one more question. In regards to the Parent Plus loan, obviously the parent is taking out the loan, and if the parent works in a public service, like, for example, I do work in a hospital, a state-run hospital. So how long after, if I take a loan out in regards to that, would I have to wait to have the forgiveness?
So the way it works is you have to consolidate the loan and then go into the income contingent repayment plan. Because normally the loan is repaid in 10 years. The public service loan forgiveness is 10 years. So the way the public service loan forgiveness works is that you have to make payments while you have the loan for 10 years while you are working for the public institution, shall we say. So you'll have to work for the hospital for 10 more years
Okay.
while you have the loan in order to have that loan forgiven.
Right, and make all your payments on time, have a clean payment repayment record.
Okay.
Well, yes. I mean, that's the way the rules are supposed to be. They've been, especially with the pandemic, there were some special pandemic level rules. Some of them have been loosened. But you know, who's going to get elected may have a lot to do with whether those rules are loose or tight.
Okay, thank you so much. I appreciate it.
You're welcome. And yeah, Sylvia comments that federal student loans, the undergraduate student loans are very small amounts. The graduate loans, which, just to confuse things, are also called plus loans. They're not parent plus loans, they're graduate plus loans. Those are not limited. I guess they figure that you're, by the time you go to graduate school, you can borrow as much as you want. And that's why, you know, students might come out with, you know, 300,000 or more of debt because they've gone to graduate school or medical school, Mike.
Medical school or law school, correct, yes.
Yeah. I said that because one of Mike's daughters went to medical school.
Without borrowing.
Okay, we've run out of questions. Any more questions? So, all right, well, I want to thank you all for attending. And I just want to point out again, you know, we do have a website, and we are giving away the book. So, you know, it does have a lot of information about the loans in it, as well as some other tax breaks and things, which we didn't talk about in this session. And of course, we do have our college money match service, which could be very helpful. Full information about that is on our website. So with that, I guess I will bid you all a good night, And happy, Mike or I would be happy to chat with you offline about our services, or if you have other questions. And have a good evening.
Thanks very much, everyone.